So hi friends, we'll now move to business income. So in the case of business income, so you know that there are certain specific deductions, there are certain specific disallowances and deemed and presumptive income provisions. So some of the amendments in this year are more to do with the presumptive incomes and certain deductions in business income. So therefore definitely, so you can watch a fair bit of questions if you go by the past ones, where normally there is a tendency to ask a lot of questions on the recent amendments. Now specific deductions, we will focus more on those deductions which are weighted deductions or which are going to be spread over a period of time, because those deductions are more important than the other deductions. Now if you take the case of expenses which are allowed over a period of time, so the most popular among them is telecom license fee. The telecom license fee is going to be allowed over the period of license. Suppose if you pay a license fee of say 1000 crores and the license is valid for 10 years. So you can claim 1000 by 10, 100 crores as a deduction. Now suppose there could be possibilities where either you start the business couple of years later or you delay the payment of license fee. In those circumstances, section allows you to adjust the denominator. For example, you got the license in 2008 but you start the service only from 2010, and instead of 1000 by 10 you should divide 1000 by 8. So this is section 35(8)BB, which is basically for telecom license. Apart from which you get deduction over a period of time for preliminary expenses, which is going to be allowed in 5 installments. The only point is you get deduction for the qualifying amount is spread in 5 installments. The qualifying amount in the case of an Indian companies, which will be actual expenditure or 5% of capital employed or cost of the project at their option. So step 3 will be the qualifying amount, is nothing but step 1 or step 2, whichever is less. So if you divide the step 3 by 5, you will get the deduction. For persons other than Indian companies, the qualifying amount will be calculated on the basis of either the actual expenses or 5% of cost of the project, whichever is less. So that will be divided by 5. It should be noted that non-residents and foreign companies are not eligible for 35D. Then move on to 35DD, which is basically for merger or demerger expenses, which is again allowed in 5 years. Then 35DDA provides for VRS payments to be allowed over a period of 5 years. So again, if you take the case of family planning expenditure, especially the capital expenditure on family planning, which is available only for a company, that will also be spread over a period of 5 years. Apart from which, zero discount bonds will be spread over the period of the bonds. Similarly, discount on issue of debentures will also be allowed over the period of debentures. So these are the expenses which are going to be allowed over a period of time. Moving on to weighted deductions, a very interesting concept. Normally, you get deduction for whatever you spend, but in certain cases the government has allowed you a deduction of more than 100% also. So when you get a deduction of more than 100%, then we call it as a weight deduction. So weight deductions are available in section 35(2)AB, section 35(1)(2), 35(1)(3), 35(1)(2)A and 35(2)AA. Now in the case of 35(2)AB, which is basically for in-house R&D, so you get deduction of 200% of the expenditure. All expenditures will be available except for expenditure on land or building, but the expenditure will be available only for a manufacturer or persons who are engaged in the business of biotechnology. The SSC must also be a company. So those are some very important points there. So even though you won't get deduction for a building here, you can still get deduction for building under section 35(1)(4). With a small rider, you will get only 100% deduction only. So key points: 200% deduction. SSC should be a company and should be engaged either in manufacture or in the business of biotechnology. You get a weight deduction of 200% for in-house R&D facility, and the facility must be approved by prescribed authority. So whereas when you make a donation to certain scientific research institutions like the IITs and so on and so forth, you will get a deduction of 170% if it is on natural science, or if it is going to be to National Laboratory or Indian Institute of Technology under 35(2)AA. So those cases will get 175% deduction. If the contribution is made to a company or for a social science or statistical research, then you will get a weight deduction of only 125%. So out of the 4 deductions in this year, 2 of them have become 175, which is 35(1)(2) and 35(2)AA, which is for natural science and for IITs and national lab. For social science and statistical research coming under 35(1)(3), or for companies undertaking scientific research 35(1)(2)A, the deduction still going to remain as 125%. So this is about weight deductions. Apart from this section, know about one more section, which is section 35, which is basically deduction for R&D. The expenditure is capital nature, then you will get 100% deduction, but no deduction is going to be available for land. You can also claim expenditure incurred before the commencement of business, so long as it falls within a period of 3 years from your date of commencement of business. It goes without saying, when even capital expenditure is allowed, revenue expenditure is also going to be allowed as deduction. Revenue expenditure will be allowed to the extent of 100%, but if you incur the expenditure before commencement of business, the revenue expenditure can be only on salaries and wages to research personnel and materials used for scientific research. So these are all about the specific deductions. Whatever important specific deductions I have covered in this video. So apart from which you can claim deduction for bad debts. As per the recent decision of Supreme Court, even if you write off the bad debts, it's sufficient to claim the deduction. It is not necessary that the bad debt should be proved to be bad. Then you also get deduction in respect of interest on capital borrowed under 36(1)(3). Its most important note, if the capital is borrowed for purchasing assets like machinery and all, till such time the asset is put to use, you cannot claim deduction, so instead should be only added to the actual cost of the machinery. So other than this, I don't find any sections which are going to be that important, because all these deductions are simplified by section 37(1), which is a general deduction. For example, you get deduction for rent house under section 30. But you don't have to know this, because even if there is no specific section for rent, you can claim deduction under a general deduction section called 37(1). The 37(1) makes this entire chapter very simple for you. As per section 37(1), if the expenditure is business and it is not a personal, if it is not a capital expenditure, if it is not a personal expenditure, any expenditure incurred by you will be allowed as deduction in the year in which you incur the expenditure. So we call this as a general deduction under section 37(1), which virtually makes the entire business income chapter very, very simple. In our next video, we'll focus on the most important aspects of business income, which is specific disallowances. Thank you.